Absolutely. These are fundamentally very sound companies, whether it's DoorDash, Affirm, Opendoor, Airbnb, Wish, Palantir. None of these companies are propelled like uniquely by the pandemic. Obviously, some companies have benefited in the short term. Think DoorDash when there was no options except to order takeout through DoorDash. But fundamentally, the company was extremely healthy before March, and it'll be extraordinarily healthy in 2 years from today.
Recently, you have made some headlines by a decision to defect San Francisco for the beaches of Miami. What's driving your decision?
Well, California is the most overtaxed and overregulated state in the country. There's no doubt about that. Those are both empirically true statements. But I think many of us were psychologically restricted in thinking about other places to live before COVID and before working remote. And once we realized that maybe one could work successfully from a lot of different places and the network effects associated with San Francisco, the Bay Area, and California might have atrophied, it unlocks lots of options of where one wants to work, live, raise a family. And San Francisco is probably not the best place.
We were talking in the last block, Keith, about how overpriced or well-priced the market might be at the moment. And clearly there have been quite a few IPOs in this past year, and the IPO ETF is up. They've been successful IPOs overall. Are you encouraging some of your VC and portfolio companies to go public as soon as they can while this market environment is fairly attractive?
Sure. Well, I'm not a fan of timing the market. I don't really profess to be a public market investor. I'm a seed and Series A investor typically. So basically, in the very beginning, when the canonical two kids in a garage are starting a company. So that's my expertise. However, I have this longstanding view, along with venture capitalist Bill Gurley, that companies should generally go public as early as possible. So I've been arguing this for 10 years, published a chapter in a book called High Growth Handbook by Eli Gill that argues substantively why this is a good decision. So all of my companies have been hearing the virtues of going public from me for 2, 3, 4, 5 years. And now finally everybody's realized it's a great idea.
Well, I will say, though, that the cohort of companies that are going public are no spring chickens. What do you think is the key benefit of going public earlier as opposed to waiting until, maybe even profitability?
Sure. So I think there's lots of benefits of going public. And in fact, the reasons not to go public are, in fact, excuses. So the reasons to go public are, first of all, transparency and accountability are always good things, whether they're imposed privately or publicly. But the idea that there's discipline within a company is a great thing, and transparency yields better discipline. Second, it gives you a currency to use for acquisitions. And acquisitions can be incredibly strategic. Think of Google buying, let's say, YouTube, or Facebook buying Instagram. Those transactions are very difficult to consummate as a private company. Third is it gives you sort of a permanence, which is basically all of my companies, all the founders I work with want to build an iconic company that's going to last for generations. And the first step in building an iconic permanent company is to be a public company. Basically, once you achieve an IPO, the chance that you persist for 20, 30, 40, 50 years, a generation or more, is very substantial. Whereas if you're a private company, the chance that you're a permanent entity and you're transforming the industry is very small.
What are valuations like, Keith, in your space, in the early stage VC investing space? I mean, clearly a lot of sectors, private and public, have had a great run over the last decade and even over the last few months. Are valuations kind of rich at the moment?
They're extremely attractive for entrepreneurs right now. Since, I'd say, June, there's been an explosion in competition among investors to invest in the highest potential companies. And we see that from seed stage rounds to the very, very beginning of capital formation to growth rounds. Growth rounds are obviously more tied to public company multiples, and so it's a little bit more rational. But even at the very, very beginnings of a company's history, seed and Series A fundraisings right now are as competitive as I've ever seen in 20 years of my life.
There's no denying that technology has been increasingly pervasive in our lives in 2020. With regard to this new administration, do you think there needs to be a Secretary of Technology, a position within the cabinet that would focus on the world of technology and innovation?
I think that's probably a bad idea. Truthfully, technology is eating, the proverbial software is eating
the world.
Right. So I think the Secretary of Commerce or the Secretary of the Treasury really needs to understand technology, because the entire economy is predicated on software and technological innovation these days.
What are some of the next gen investments that you're looking at right now? What do you think are going to be the Airbnbs, the DoorDash, the Affirms of the world in, say, 5 years?
There's a few. I mean, I'm not a macro sort of hypothesis generating investor. I'm basically a bottom up founder driven investor. So for me, the key is what's the quality of the founding team versus like some top down belief about the future of the world.
Shepard Smith here. Thanks for watching CNBC on YouTube.